I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, money manager and financial expert, big Wall Street guy, Michael Pento of Pento Portfolio Strategies. Michael Pento, thank you for coming back on USAWatchdog.com.
Thanks so much for having me back on, Greg. Love to be on with you.
You were a big hit last time, and you're a market guy. You got tons of Wall Street experience. You manage big money. You give big advice to big investors and clients. And I wanted you to get into your head about this Greek situation. We've been told for years that it's okay. They're going to leave an exit. Man, it looks like talks have broken down or breaking down. It doesn't look like, I don't know if this is a negotiation ploy or whatever, but it's not looking good. What are you telling your clients? What do you think about what's going on with Greece?
I think there's an obsession over Greece, which I find very distracting. First of all, let's look at the facts. The facts are that back in 2012, the Greek government defaulted on or restructured 85% of all of the publicly owned debt. 85%. So they took haircuts of 53% on the principal and extended the interest payments. This is supposed to solve all the problems in Greece. If you don't believe me, look it up. Look at the Greek debt restructuring back in 2012. This was supposed to be the panacea. But guess what? We're 3 years later, and the debt to GDP in Greece is higher today than it was in 2012. So now the Troika is saying, well, we're not going to give them the bailout money unless they increase taxes in Greece. They don't collect taxes in Greece. I don't understand. Greece needs to adopt austerity. The Troika is not going to keep bailing out these people unless they adopt austerity. But that's not going to be a cure-all. Like I said, 85% of the debt was restructured, and here we are back in a worse condition 3 years later. So Germany, the Troika, they're going to own these people. They have to continue them on bailouts ad infinitum for many years to come. So the Greece situation isn't going to go away. But more importantly, Greg, this is the key that people have to understand. This is all about the level of interest rates. If you look at all the swaps and derivatives that are associated with the banking system and the gambling leverage out there, it's all tied to something known as LIBOR, which is the London Interbank Offered Rate. What you need to know about LIBOR is LIBOR always spikes during crises. It happened in 2008. It's going to happen again. And all of these interest rate derivatives, which I said are being priced off of LIBOR. If you're sitting there trying to exchange a fixed income stream for a variable rate interest, and now you have to pay LIBOR plus whatever you're paying, you're going to become insolvent. There are going to be a lot of people out there who are guaranteeing interest payment streams that are going to look like AIG. And that's what the number is, $100 trillion in derivatives. This is very bad news, and nobody's
quadrillion
about it except for people like you, Greg.
A quadrillion.
Quadrillion.
The BIS call it a quadrillion. I'm like 1,000 trillion. I mean, that's the official number. Some people say it's way more than that. It's twice that much or something.
I use 100 trillion just to be conservative, but does it really make a difference if it's 100 trillion or a quadrillion? There's no money to back up these interest rate derivatives, these swaps. It's just money isn't there. So people are going to say the counterparty risk is going to be right back in the mainstream as it was in 2008.
Could Greece implode the system? Could if Spurious says, okay, forget it, we're out, we're done. If he does that, could the system go down?
Well, first of all, if Spurious could say we're out, we're done, or Germany can kick them out of the European Union. I mean, either case, and then you have contagion risk that could be prevalent. People could say, well, Portugal doesn't have to pay the IMF, and maybe Italy doesn't have to pay the IMF, and maybe Ireland doesn't have to pay, and Spain doesn't have to pay. So there is some kind of, they take one flag down of the EU 19, and then what about the other flags other than Germany that are in the European Union? So yes, it could spread contagion, but I am more interested. That's why I consider this more of a distraction. It's a small piece to the puzzle. You look at debt that extends all across the planet. Every asset on the planet is in a bubble. China's in a bubble. Japan's in a bubble. Europe is in a bubble. The United States is in a bubble. And that's not just stocks. It's bonds, it's real estate, it's diamonds, it's art. Look, China fell 7.5% last night because every housewife and widow in China opened up a margin account, and now they're wiped out, and the market's down 18% in the last week alone. And it's got a lot more to fall. Who's there to support that? And this is where the rubber meets the road, Greg. Oh, don't worry, Greg. Don't worry, Mr. Pento, because central banks have our backs. Well, when the hell has that been the case, that a central bank can monetize unlimited amount of debts, destroy the currency, create money out of thin air, ad infinitum, without any consequences? When has that ever been the case? Well, I'm telling you right now that either the Federal Reserve gets off its ass and starts raising interest rates, or the free market is going to do it for them. And that's what's happening today. You see the 10 years at 2.47% and rising. Inflation expectations, look at the five-year forward contract. I don't want to get too much in the weeds. All I'm telling you out there is that you cannot continue to print unlimited amounts of money and have everything be quiescent. It's just not the case, and it's going to come back and bite investors in the butt very shortly.
Could China blow the thing up? I mean, what you're saying is that Greece is tiny, China's huge. Could what's happening in China could roll over to Europe and roll right around the globe to the United States?
I think, Greg, like I said, China is 1 or 2 percentage points away from being an official bear market territory. And this nation, which is a command and control communist organization, which was enamored with building empty cities on a 25 times increase in debt. Not 25%, 25 times increase in debt since 2000. They got tired of building empty cities. They decided to build empty stocks and have a shell economy boost this particular asset class to the moon. And it went from 2,000 to 5,000 on the Shanghai A-share exchange. And now this thing has no bottom to it. And I don't think you could just come out with the People's Bank of China saying, oh, we're going to lower reserve requirements. I mean, who cares about that? We're going to lower margin requirements. You've got people now that have lost all of their money, all of their life savings in Chinese shares in 1 week. That confidence doesn't come back so quickly just because you're lowering a reserve requirement.
A lot of folks think that we're going to have trouble this fall, and the trouble's already started. I mean, look at Carl Icahn, who's like, I'm out. I mean, I'm going to, in USA Today, the day before is out where there's 10 great stocks to buy. They have a lot more room to run. I'm like, Carl Icahn just sold all of his Netflix shares. I'm going to go with Icahn.
Yeah.
If he says there's trouble, I believe him. What do you say?
Well, listen, I was before Icahn, and I believe I'm not anywhere near the investor of Carl Icahn, but I've been out of the market since October of 2014. Not out. I'm 50% in cash. I own some gold shares because I think that's the most underappreciated asset on the planet. Everybody, the dollar's always going to be rising against the euro, and the gold market is going to be crushed. I had someone on yesterday saying, well, nominal interest rates are rising, so it's the end of the gold market. But let me ask you a question. Since when did nominal interest rates make a rat's bit of difference with the gold market? It's the level of real interest rates. Nominal rates rising to catch up with the level of inflation, and they're always going to be behind. So real interest rates are going to be falling dramatically because the Fed is way behind the inflation curve, and that's going to send gold up, rising in real terms, just like it did from 2002 all the way to 2008. And that was in an environment of rising nominal interest rates. And by the way, the Fed took interest rates from 1% to 5.25% during the time frame I just mentioned. The Fed is stuck at zero, and they can't get off zero because that's what happens when they get off zero. The interest rate market, the derivative market collapses. Everybody who's investing in REITs gets crushed, and these master limited partnerships get crushed. The whole economy gets wiped out, including real estate, stocks, and bonds.
What do you say about all these bonds held as assets in the banks in this even nominal rising interest rate environment? I mean, it's they got this is according to the Bank of International Settlements, a quadrillion, 1,000 trillion in derivative bets. A lot of those are interest rate derivatives. What happens to the bonds, to the collateral?
First of all, because of Basel III and the Dodd-Frank law, these banks had to hold all of these bonds because it didn't count against their capital reserves. So they're loaded up on U.S. Treasuries. Now they could say, well, they could always hold Treasuries to maturity. But the bottom line is these banks are going to be, if you look at real terms in real time, insolvent because their assets are going to be destroyed. The value of their assets is going to go down, which means their capital is going to be eroded. So you could say, all right, well, guess what? We'll just hold the bonds to maturity. But how are they going to make any loans if they have no capital?
Isn't this going to be another mad dash for collateral? Isn't gold going to be the premier collateral once again? Isn't that another story for gold? It'll turn into collateral. I mean, that's why we had the meltdown in 2008. Nobody trusted the collateral. We had a debt crisis. Isn't gold going to be the premier collateral in the future?
Well, Greg, I mentioned all the bubbles that there are out there. The biggest bubble out there that there is an increase in faith in central bankers to save the world. This is why you can have Chinese shares drop 7.5% in one day and have the Dow Jones Industrial Average up 90 points as this recording is being made. Because nobody cares anymore. Because what do I hear on the radio and TV all this morning is that who cares if Greece leaves the Eurozone? Who cares if Chinese shares collapse? Because the People's Bank of China will just print money. Who cares if Greece leaves the Eurozone? Because didn't Mario Draghi assure us that he'll do whatever it takes? Who cares if inflation in the United States starts to become intractable? Because didn't they say that Janet Yellen and company would just buy all of the sovereign debt there is to keep interest rates low? Who cares? But the free market always wins. It will always trump government. And that's why I'm so petrified about investing right now. I think we are in the most dangerous time frame we've ever been since the history of economics. And I think what's going to replace this faith, this misguided and spurious and specious faith in central bankers is going to be a renewed interest in hard money, in specie, in precious metals. We're going to throw out the central bankers, and we're going to universally think it's been absolute madness to think we can put the faith in just a small, unelected, and unaccountable group of people. We're going to put our faith back into gold and silver as money. That's what I'm really looking forward to, Greg. Great news for the economy and the people of America in the long run.
Michael Pento, I interview a lot of people. That's what you said about the faith in central banks is one of the most brilliant, succinct things I have heard in a long time. I mean, just a light went off in my head because people have been wondering, how can this go on as long as it has? How can it go along as long as it's been going on? Well, part of it is, massive fraud and rigging LIBOR and rigging the Forex market, which they admitted to. They've admitted to all this.
This is what they admit to, Greg. They admit to currency rigging, LIBOR rigging, commodities rigging, S&P mini futures rigging. This is just what we catch them on. Of course they're rigging the gold market too. But eventually, and history is very, very clear in this, free markets always prevail. And that's what I'm looking forward to. The return and the vengeance of free markets.
There's a lot of folks, whether you believe in 7-year death cycles or whether you believe in the Shemitah or whether you believe in the math is just awful. A lot of folks think this fall is going to be rough sledding. What say you?
Well, it all depends on the slope of the Fed funds rate. So we have Ms. Yellen's going to come out in September and most likely raise the Fed funds rate by 0.25 percentage point. And then it's up to her to get out there in her school marm outfit and say, we only went once and we'll never hike again until inflation is well above 2%. She's got to convince markets that's the case. Because if she doesn't do that, and the markets are convinced that they're going to follow the plot points of the Federal Reserve, the so-called dot plots, which say they're going to be at 1.7% by the end of 2016. If they do that, Greg, if they fail to convince investors that they're going to do one and done, but they're actually going to instead follow this dot plot regime, then we're going to have a flat or inverted yield curve by the end of 2016. And I'll remind you that the starting point, the spread between the 10-year, the belly of the curve, and Fed funds rate is abnormally low. It's usually about 350 basis points. Today it's about 225 basis points. The Fed is going to be hiking just because they're paranoid about being at zero for 7 years. That's the only reason why they're hiking. They're not hiking because we have runaway growth. Growth, the first half of 2015 is going to be 1%. So they're going to flatten out the yield curve very quickly, which is going to cause the whole entire bubble to implode by 2016. And if they do the other scenario, which is just hike once and just stay way behind the inflation curve, then I believe you're going to be on a watch for that long-term treasury market, not only in Europe, in Japan, in China, and the United States, to absolutely become intractable. It will rise back to 4, 5, 6%. And that's exactly what happened in 1987. In 1987, the Fed funds rate did not go up much at all. If you look at the effective Fed funds rate in 1987, it barely moved at all. It went from like 5% to 6%. But the long-term interest rate regime, the long-term cycle of interest rates spiked. It went from 7 or 8% all the way up to 10%. And that brought us 1987. You're going to get a 1987 event sometime in 2016 if the Fed does a one and done and stays behind the inflation curve. So either way, interest rates are going to normalize, and we're going to get an absolute awakening. and we will shatter the faith of central banks and hopefully get back to a gold-based monetary system.
If you look at the leverage in the world in 1987, and you look at the leverage today, I mean, it is orders of. I mean, my head is going to explode.
If you look at the debt to GDP, I'm talking about all debt in the United States is about 40% debt to GDP. If you look at, household debt as a percentage of GDP was about 40%. Today, it's almost 80%. It's doubled. And if you look at the national debt, we've gone from, in 2007, $9 trillion in debt to $18.2 trillion in debt. So the debt is off the charts, and that's a $60 trillion increase, by the way, if you look at it globally. $60 trillion increase in debt since 2007. This is unprecedented. It's never happened before. There's going to be a lot of insolvencies that's going to occur when interest rates normalize. And investors have got to be very cautious. You have to have a money manager that's watching the slope of the Fed funds rate. You're going to either be in for a deflationary depression very quickly as that yield curve flattens out due to a aggressive Federal Reserve, or, and this is more likely, you're going to have to watch assiduously the long end of the yield curve, because once that breaks 3.5%, watch out. This market will absolutely tank, along with every other phony engendered asset class that's been sponsored into the stratosphere by the Federal Reserve.
So after listening to you, I just keep thinking to myself, gold, cash, gold, cash. Gold. I mean, what are you doing?
You know, it's funny that you said that because, when you really think about it, and that's how I manage money, part of my income by writing books and my podcast, is managing money. And guess what? That's where I'm mostly at. I have 50% cash. I have some gold shares because everybody, as you said, this is the most unliked asset class in the history of investing. There's not a friend in the world. But and this is only for one reason. It's not because interest rates are so high. It's not because central banks have hard money policies. It's because the dollar is rising against the euro. Well, who really cares? But let me tell you this. That condition is going to reverse itself very shortly, because I believe when Janet Yellen moves in September, or doesn't move at all, if she moves in September, she's going to go out of her way, be effusive in her prognostications that the Fed funds rate is going to be low for a very, very, very long time, which means real interest rates, this is the key, real interest rates are going to be falling. And the dollar is not going to be rising any longer against the yen and the euro. And that's when gold, I think, is going to really take off.
Michael Pento, Pento Portfolio Strategies, the website, pentoport.com. That's where people can find your podcast. It's, what is it, $49 a year?
$49.99 a year.
$49.99 a year, and you get this? Oh, boy. That sounds... one of the better interviews I've had in a while, Michael Pento, not just with you, but with anybody. But again, pentoport.com is where they can find you. Michael Pento, thank you for joining us today on USAWatchdog.com.
Always a pleasure to be with you, Greg.